Welcome to Crops, Cattle, and Charley. I'm Charley Martinez, and I'm joined today by Aaron Smith and the University of Tennessee Livestock Economist, Dr. Andrew Griffith, who's with the Department of Agriculture and Resource Economics. Today, Dr. Griffith is going to be discussing fall feeder cattle marketing. So, Dr. Griffith, what can producers expect from the market this fall?
Well, I think, Charlie, that there's a lot of positive aspects to the market this fall. We've in July and August, we saw feeder cattle prices really start to strengthen as feedlots restock pens. You know, it doesn't seem that we have as big a backlog of cattle as what was previously thought. And this yearling cattle market, I think it's going to hold in September and October pretty strong, and maybe moving into November. The futures prices have been fairly strong, all plus 140 plus type price range. Some, even reaching as high as 145, 146 at times. Will we still be that high on feeder cattle? Probably not. But if we're 140 plus, I think that's a good place for anybody that owns those cattle. Probably not a terrible price for feedlots to be buying those cattle either. When you get down to fall marketing, though, more importantly than yearling type cattle, a lot of people are worried about their spring calf crop marketing. And what we generally see, though, is a lot of bigger operations will actually market those animals in August and September for October, November, or December delivery because of the price bumps that they generally get by forward contracting those type cattle. But I still think we're going to have a stronger calf market than what was initially thought maybe 3 or 4 months ago. Are we looking at probably in Tennessee, looking at around $720 a head for a 550-pound steer, somewhere between $700 to $750 a head on steers weighing 550. Is that a bad price, a good price? Well, it's something that's survivable is what it is. And so that market is looking a lot stronger than it was last year and really a lot stronger than what we thought it might have been 3 weeks ago.
So, Andrew, are there opportunities to protect a price and the value of cattle?
Yeah, Aaron. The futures market has definitely offered some opportunities for people marketing in load lots, whether that be through a straight hedge. When we hit 145, 146, that was a great time for a straight hedge. And if we hit those marks again, it again would be a good time for a straight hedge. We've also had some good opportunities with options. So essentially it's like an insurance type product. But for even smaller producers, the livestock risk protection has offered some really nice opportunities in the past few weeks. And I suspect that it'll continue to offer some opportunities since they've made the changes to livestock risk protection where it's a little higher subsidy. That the prices of the product have increased as well, even as the subsidy increased. But they are a little cheaper than options are right now. It used to be they were very much in line, even with the subsidy, to be pretty much the same cost as an option, a put option. But with the changes that were made earlier this year, those are a little cheaper. Some great opportunities to lock in a decent sale price anytime this fall and moving in even into next year.
Awesome. Good stuff, Andrew. And thank you to the viewer for joining us on this episode of Crops, Cattle, and Charley. We hope you enjoyed it, and we hope you join us again on the next one. Thank you.